What if the market you trust is built on an illusion? What if the numbers you hear on the news are designed to make you act without thinking? And what if the very people you believe are guiding the economy are the ones setting the trap? When your paycheck depends on hard work and long hours, when you save carefully for your future, you expect the system to be honest. You expect the rules to be clear, but in today's markets, the rules can be rewritten at any moment, and you are rarely the one holding the pen. In the last year alone, we have seen powerful headlines telling us the economy is strong, unemployment is low, markets are recovering, confidence is back. But behind those headlines are numbers that shift like sand. One month they look solid. The next month they are revised so sharply that the original story no longer holds. Why would anyone do this? Because confidence is a currency. If they can make you believe everything is fine, you will keep buying, you will keep investing, and you will keep your money in the system. This is not about panic. It is about awareness. When you understand that data can be shaped to tell a story, you begin to look for the truth behind the story. The market is not always a fair game. The winners are often those who see the setup before everyone else does. If you can see the pattern early, you can protect your money and even grow it while others are losing theirs. The passive path exists to give you that early vision, because when you know how the game is played, you don't have to be the one paying for someone else's win. What if the next good news you hear isn't really good at all? What if it's the signal that the trap is about to close? The market can look healthy even when the foundation is weak. A strong rally can appear out of nowhere, prices shoot up, confidence surges, and investors rush in. But a rally without solid fundamentals is like a house built on wet ground. It can collapse without warning. We have seen this pattern before. Employment reports come out looking strong. Jobs added by the hundreds of thousands, unemployment rate steady or falling, the message is clear. The economy is thriving. But then quietly, the data gets revised. Those hundreds of thousands of jobs turn into tens of thousands or vanish entirely. This isn't just a statistical error. It's a way to control the mood of the market. Good numbers draw in buyers, bad numbers drive them out. If you can move the crowd, you can move the market. Even legendary investors can be caught in the wrong place at the wrong time. They might sell too early and miss a rally, or hold too long and watch gains disappear. The difference is, many of them have the cash reserves and influence to recover quickly. Most everyday investors do not. The key is not to blindly follow the headlines. The key is to ask, who benefits from this move? Who gains if confidence rises, and who gains if fear takes over? When you think this way, you stop reacting to every piece of news, you start watching the flow of money instead of the noise, and you give yourself a chance to act with intention instead of impulse. The passive path is built on that principle. Wait for clarity, move when the odds are in your favor, and never forget that the first move in the market is not always the winning move. One of the most powerful tools for influencing the market is jobs data. In the United States, the non-farm payroll report is watched closely by traders. It shows how many jobs were added or lost in the economy each month. If the number is high, it signals growth and strength. If the number is low, it signals weakness and caution. For decades, the rule of thumb was simple. Over 100,000 new jobs in a month means the labor market is strong. Under 100,000 means it is struggling. Investors built strategies around this. They reacted instantly to every new release. But what happens when those numbers are wrong? Not slightly wrong, completely off. We have seen months where reports claimed over 140,000 jobs were created, only to be revised down later to less than 20,000. That is not a small error, that is a complete shift in the story. Imagine making a major investment decision based on those original numbers. You would have believed the economy was in a boom. You might have committed large amounts of capital, and by the time the truth came out, your position could already be deep in the red. This is why professional investors sometimes wait, they don't rush. To act on the first report, they watch for patterns across several months. They want to see if the data holds up after revisions. If 3 months in a row the jobs numbers are weak, it often means there is a real slowdown happening, not just statistical noise. And if the government openly admits the original data was inflated, that is a signal worth paying attention to. When you see strong markets built on weak labor data, be cautious. It could mean the rally is being fueled by perception rather than reality. And when reality catches up, the drop can be fast and unforgiving. Debt plays a central role in shaping the market. When a government issues short-term bonds, it is borrowing money from investors. These bonds are considered safe. They pay a fixed return after a set period, but they can also be used as collateral to borrow more money before they mature. Large investors use this to create leverage. They buy a bond worth $1 million. Instead of waiting for the interest a year later, they pledge the bond to a bank in exchange for $950,000 immediately. They then use that borrowed money to buy more assets, often more bonds or stocks. This cycle can repeat multiple times, each step pulling more liquidity out of the same original investment. Banks can also pledge those same bonds to the central bank for slightly more cash than they lent out this way. Everyone in the chain makes a small profit without waiting for the bond to mature. The result is that $1 million of real capital can create $20 million or more in market activity. On paper, this looks like strength. In reality, it is fragile. If any link in the chain fails to repay, the entire structure can unwind quickly, and because so much of the market is connected, a shock in one area can spread rapidly. When you see a strong stock market at the same time, government is issuing large amounts of short-term debt, it is worth asking if that growth is being fueled by genuine investment or by layers of leverage. If it is the latter, the gains can disappear just as quickly as they appear. The value of the dollar is just as important as the level of the stock market. For investors outside the United States, a falling dollar can erase gains even if their stocks go up. If you buy US stocks, when the dollar is strong and it later drops by 15%, your portfolio value in your home currency could be down even if the stock price stayed the same or rose slightly. There are 4 basic situations to watch when the dollar rises and the US market rises. That is often the best time to invest. When both fall, it is usually a time to step back. When the dollar rises but the market falls, may still lose in stocks but can gain from currency strength. When the dollar falls but the market rises, your gains may be weaker than they appear. Many people only look at stock charts and ignore the currency chart. This is a mistake. The currency is the lens through which all foreign investors view the market. If that lens is distorted, the picture of your returns is also distorted. For example, if the S&P 500 gains 10% in a year, but the dollar loses 10% against your currency, your real return is close to zero. Understanding this relationship can protect you from making investments that look good in headlines, but deliver poor results in reality. The passive path teaches you to check both before making a move. A strong market with a weak dollar can be a warning sign, and a strong dollar with a strong market can be an opportunity worth acting on. Markets often trap investors in 2 distinct waves. The first wave happens after a sharp drop, prices fall hard, panic spreads, then the selling slows, a small bounce appears. This bounce attracts bargain hunters who believe they are buying at the bottom. They commit their cash expecting a recovery. The second wave comes after a strong rally. Prices have been climbing steadily. Confidence is high. People who miss the first rally feel pressure to join before prices go even higher. They buy in at elevated levels, convinced the trend will continue. Both groups can be caught when the market reverses. Again, if prices drop after the bargain hunters buy, they are stuck holding losing positions. If prices collapse after the momentum buyers join, they face heavy losses almost immediately. This pattern is often called catching fish in a barrel, because once the investors are inside, they have little room to escape. Large players can then push prices in the opposite direction, locking in profits while smaller investors take the hit. Recognizing this setup is critical. If a rally follows a deep drop without strong fundamentals, or if a surge follows months of steady gains without real economic support, it may be the start of one of these traps. Waiting for the cycle to fully play out can save both capital and stress. The best opportunities in the US stock market happen when 2 forces align. The dollar is gaining strength, and the market itself is trending upward. This combination can create powerful returns for both domestic and international investors. When both move in the same direction, it signals confidence not only in the companies listed on the exchange, but also in the currency they are priced in. Investors from around the world are buying. Demand for both assets rises, and the gains are reinforced on 2 fronts. Other situations are less favorable. If both the dollar and the market are falling, it often means capital is leaving the country. If the dollar rises but the market falls, you may make gains on currency but lose more in stocks. If the dollar falls while the market rises, your stock gains can be reduced or erased when converted back to your own currency. Patience is key. It can take months for the right setup to appear. During that time, capital can be preserved in other assets, short-term bonds, gold or cash equivalents. The goal is to be ready with buying power when the market and currency move together in your favor. The passive path is about waiting for those moments, because one well-timed investment can outweigh years of small gains and losses combined. When the timing is not right for US stocks, money does not have to sit idle. There are other places to park capital while waiting for the right conditions. Short-term government bonds can provide safety and modest returns. They keep funds liquid, allowing quick entry into the market when conditions improve. Precious metals like gold can serve as a hedge. They often hold value during market uncertainty, and they are not tied to the performance of a single country's economy. Cash reserves are another tool. Holding cash means no forced selling during downturns. It also provides flexibility to buy assets at attractive prices when opportunities appear. Certain exchange-traded funds can give exposure to defensive sectors. Utilities, consumer staples, and healthcare often remain stable when markets turn volatile. The key is to protect capital first. Growing it comes second. By keeping resources safe and accessible, you are in a position to act quickly when the right market and currency alignment returns. The passive path approach is to treat readiness as part of the investment strategy because opportunities are useless if you do not have the means to take them. A strategy that survives market manipulation is built on 3 pillars: observation, patience, and decisive action. Observation means tracking both the market and the forces that move it. Noticing when economic data does not match real-world conditions. Seeing when rallies are built on weak foundations or when fear is being pushed harder than facts. Patience is waiting for the setup that matches your plan, not chasing every rise or trying to catch every dip. Knowing that the market will always offer another opportunity and that rushing often leads to losses. Decisive action is moving with confidence. When the moment comes, deploying capital in the right amount in the right asset. And with a clear exit plan, this includes using position sizing to limit risk and protecting profits when they appear. One large win at the right time can outweigh multiple small losses. The goal is not to win every trade. The goal is to avoid the kind of loss that sets you back years. The passive path focuses on protecting the downside first, because once capital is preserved, the upside takes care of itself. Do you like this personality? To make better decisions, watch the dollar index alongside market charts. If the dollar is falling sharply while stocks are rising, question the strength of the rally. If both are climbing together, is often a stronger signal. Be cautious of economic data that looks unusually good. Ask if it will be revised later, or if it is being used to influence sentiment. Markets move on perception before reality catches up. Patience is not inactivity, it is active preparation, building cash reserves, lining up watch lists, and setting clear entry and exit rules. When the opportunity comes, move in. Stages start with a partial position. Add more only if the market confirms your direction. This reduces risk and keeps flexibility. Think in terms of preserving buying power. If a trade fails, you still have capital for the next one. If a trade wins, you can compound the gains into the next opportunity. The passive path is about thinking ahead, not just for the next move, but for the moves after that. Because the market rewards those who are ready before everyone else. Like this video, subscribe to the channel, and share your thoughts in the comments. Your journey to financial independence starts with taking control of your own decisions. If you found value in what you heard today, like this video, subscribe to the Passive Path, and leave a comment with your thoughts or questions. Share this video with someone you care about, because the right knowledge can change more than one life. I wish you the best of luck in your financial journey. Feel free to watch the other videos on this channel. Each one is made to help you think clearer and act smarter in the markets. See you in the next video on The Passive.